You know, when a company drops its earnings report, you usually expect a pretty straightforward story. Good news, stock goes up. Bad news, stock goes down. Simple, right? Well, with Wells Fargo's latest Q4 results, it was anything but simple. In fact, it's like we're looking at two totally different stories being told at the same time. So here's the big question we're going to tackle. On paper, Wells Fargo crushed it. They delivered a strong earnings beat, way better than what Wall Street was expecting. But then you look at the stock, and it immediately dropped. So what gives? How does a company seem to win the game, but still lose on the scoreboard? Okay, let's dive into the numbers. So check this out. On one side, you've got the headline number that got everyone's attention, an adjusted earnings per share of $1.76. That's a solid beat over the $1.66 analysts were looking for. But then, on the other side, you see the market's reaction. The stock price falls 2.7%. And that right there, that's the mystery we need to solve. All right, to get to the bottom of this, we've got to look at the quarter from two different angles. First up, let's look at it from their perspective, from the inside. Because for them, this wasn't just a good quarter. Oh no, this was the grand finale of a massive, multi-year turnaround effort. And listen to what the CEO, Charlie Scharf, is saying. It's really telling. He's pointing to two huge victories. Not just the strong numbers, but finally getting that Federal Reserve asset cap removed. I mean, that thing has been handcuffing their growth for years. For the folks inside Wells Fargo, man, this was a huge, huge win. And this number, wow, this just screams confidence. A stock buyback is basically the company betting on itself. And you don't spend $5 billion buying back your own stock in just 3 months unless you're feeling pretty good about what's coming next. And get this, over the whole year, they returned $23 billion to shareholders. That's a powerful statement. Okay, so where are all these profits coming from? Well, a big piece of the pie is this thing called the efficiency ratio. It's a super important number in banking. It basically asks, for every dollar the bank makes, how many cents does it have to spend to earn it? And they managed to slash that cost from 68 cents down to just 64 cents. That is a massive operational win. And this slide really breaks down how they pulled it off. Expenses are down. They've cut headcount. This is the result of a 5-year, $15 billion push to become a leaner, meaner machine. They call it the disciplined dividend, and you can see why. So yeah, from the inside looking out, the story is simple. We nailed it. All right, so if everything's so great inside the bank, we're back to our big question. Why on earth did the stock fall? And that's where we have to switch gears and look at this from the market's point of view. Because investors were looking past all the cost cutting and seeing some potential cracks in the engine for future growth. Okay, this table right here, this is basically the smoking gun. Yeah, sure, that bottom line EPS number was a beat, but look up top. Total revenue, a miss. And even more important, net interest income, which is the bank's core profit from making loans, that missed too. What the market saw was that, sure, profits looked good, but it was because they were spending less, not because they were actually making more money than expected. Now, to really get this, we've got to talk about a key term in banking, net interest margin, or NIM for short. Think of it as the bank's fundamental profit margin on its main business of lending. It's what's left after they pay you interest on your savings account and collect interest on a car loan. A healthy, growing NIM is the lifeblood of a bank. And boom, this chart shows you exactly what Wall Street was worried about. Wells Fargo's NIM is actually getting squeezed. It fell from 2.7% down to 2.6% in a year. Basically what this means is the cost of their money, what they have to pay us for our deposits, is going up faster than what they're earning on their loans. And that creates a major headwind. And it wasn't just about the past either. When the leadership team gave their outlook for the year ahead, their forecast for that super important net interest income was also a little weaker than analysts had hoped for. So the market is seeing this trend, right? Margins are getting squeezed now, and the company's own forecast for tomorrow isn't exactly knocking it out of the park. Okay, but let's shift gears because there's another massive piece to this puzzle. For years, Wells Fargo has been stuck in a regulatory penalty box. The Fed literally forbade them from growing past a certain size. Well, that punishment is over. The bank has finally been let out of its cage. This timeline just shows you how long this has been going on. That cap was put in place way back in 2018. It was finally lifted in June of 2025. And by the end of the year, you can see their assets are already at $2.08 trillion, way past that old limit. The shackles are off. It's game time. So now that they're free, what are they doing with it? Well, they're stepping on the gas. Commercial loans are up 12%. Auto lending is back with a vengeance, up 19%. And they're signing up 20% more new credit card customers. You can see it right here. This is a bank that's finally on the move. So picture this. You've got this amazing moment. The internal turnaround is done, the regulatory shackles are off, the growth engine is just starting to fire up. And then, bam, out of nowhere, this huge potential threat, a real political black swan event, shows up on the radar and could mess up the whole party. And what is it? Well, here you go. A proposal suddenly popped up in Washington to put a federal cap of 10% on all credit card interest rates. When this idea came out, it sent an absolute shockwave through the entire banking world. I mean, just look at these numbers to see how massive this is. Right now, the average credit card interest rate is somewhere between 20 and 30%. The proposal is to force that all the way down to 10%. You're talking about cutting the revenue from one of their most profitable business lines by more than half. Just gone. The fallout from something like this could be absolutely massive. Some analysts said it could wipe out all credit card profits for an entire year. And in response, banks would almost have to slash credit limits for millions of people, and maybe even stop lending to anyone who isn't a perfect borrower, which would just pull the rug out from under a huge part of the economy. So all of this puts investors in a really tough spot. On one hand, you've got a company that just pulled off a brilliant turnaround. But on the other, it's now facing this complex and kind of hostile new world. It's a classic Wall Street showdown, the bulls versus the bears. So here's the breakdown of the two arguments. The bulls, guys like Bank of America, are saying, hey, their cost cutting is the best in the business, the stock is still a bargain, and those huge buybacks will keep the price from falling too far. But the bears, like the folks at Baird, are saying, not so fast. Everyone's expecting too much, the stock isn't cheap anymore, and growing actual revenue is going to be a real struggle. And that really brings us full circle. The Q4 results proved one thing for sure. Wells Fargo has fixed its house. The turnaround? It's real. They pulled it off. But is all that new internal discipline going to be enough to handle these new external challenges, the squeezed margins and this huge political risk? And that is the multi-billion-dollar question that's going to decide where Wells Fargo goes from here.